everybody. Welcome to Zoom at 8. My name is Julianne Peterson. I'm your host tonight for Zoom at 8. I am a loan officer for Old Capital Lending. Tonight, I am beyond excited to introduce to you Spencer Burton. And Spencer, I met Spencer probably a year and a half ago, maybe, before COVID. And I was thoroughly impressed with Spencer. You know, when I think about people that do some of this coding and doing like spreadsheets and all of that kind of stuff, I always think that they're a little bit, you know, not as friendly or not, let's say more in the books, let's say. And so when I met Spencer, I was like, hey, he's a little bit different. So I want to get to know him. And, you know, obviously we're working on continuing to build that relationship. But I thought Spencer would be a great asset to our team here. And, you know, some of you work on different types of modeling tools. I'm an advisor on the Michael Blanc group, and he has the SDA that many of you look to. David Tupin has his own, Robert, what's his name, has his own, and so has his own, and Rod has his own, and everybody, Brad has his own, everybody has their own. But I have to say that Spencer's is by far the most incredible piece of artwork that he puts together that really will make your head hurt and make you go, because he looks at things very differently. So let me tell you a little bit about Spencer. He was born and raised in the northwest part of the United States. He has nearly 20 years of residential and commercial real estate investment experience. Over his career, Spencer has helped close $4.5 billion and underwritten $30 billion in commercial real estate at some of the largest institutional real estate firms in the world. He is currently the head of the real estate investments and member of the founding team of Stablewood Properties. Spencer is also a co-founder and lead contributor of Adventures in CRE. And this is how I know Spencer, is through his Adventures in CRE. If you have not looked up Spencer, it would be wise to look up. Maybe you could bring that up as Spencer is, you know, bringing us through some of this stuff tonight. And he has this Adventures in CRE is actually the most visited real estate financial modeling training website on the web. You are in the presence of a real rock star tonight. Spencer, he holds a Bachelor of Arts in International Affairs with an emphasis in economics from Florida State University and a master's in real estate with a concentration in finance from Cornell University. So Spencer, thank you so much for joining us. I do want to make sure that everybody knows that Spencer, he set out to build an all-in-one modeling tool that does it all. And right now, it almost does everything. I don't think it cleans my toilets or my plates in my dishwasher, but this thing can look at acquisitions, value add redevelopment, ground up development, industrial, office, retail, multifamily apartments, student and senior housing, various partnership structures, advanced underwriting modules, tabs that automatically hide and unhide depending on the selections you make, and that list goes on. Oh my goodness. So I am just so thrilled, Spencer, you are here. I want everybody to know a little bit about you, a little bit more about you. I just am so thrilled you're here.
Well, thank you, Julie. Let me share my screen. Let me know if everyone, can you see that?
Yep, absolutely.
Okay. I hope we're looking at kind of a little heading there. This is a PowerPoint. So I apologize. So I have two challenges here. The first challenge is, you know, we're in a Zoom environment and nothing is engaging in a Zoom environment as it is in person. The second is, this is a topic that, I kid you not, is the boringest topic around. Now, I've spent over 10,000 hours perfecting this skill. And there's a few of us that really nerd out on this. I think most of us fall asleep though when we think about real estate financial modeling. So I'm going to do my best to make this as interesting as possible. As Julie mentioned, my name is Spencer Burton. Just a little about me, as she mentioned. So I'm roughly 20 years in the business. I've had the pleasure of investing both from my own account as well as on behalf of some great real estate institutions. Undergraduate in international affairs and economics, and then I spent a couple of years studying real estate finance at Cornell. Most recently, I am the head of investments at a real estate startup called Stablewood Properties. We're led, our CEO is the former CIO of Hines, if you're familiar with Hines Development. And I'm one of the founding partners, a minority partner, but happy to be a partner nonetheless. And in our current strategy, we buy single tenant net lease essential retail, we aggregate into portfolios and then recap to large institutions that want exposure to essential retail, but don't have the bandwidth to buy $2 to $10 million assets. But I've really had the pleasure of investing across virtually all property types. I spent quite a bit of time in the multifamily sector when I was working for the real estate investment arm of a large life insurance company. We did a lot of ground up apartment, but also stabilized and value add apartment deals. And so I know many on the call here are in the multifamily space. I'm happy to speak to that. But when I think about real estate, I get excited about all property types because this space, it's really about forecasting the future, and that's really what we're doing. And so the foundation of my 30 some odd minutes that I have here is talk about what that means. A little bit about Stablewood, and then I'll talk about what I do at Adventures in CRE. So at Stablewood, like I said, I'm the head of investments. We started in early 2020. We're partnered with a household name insurance company. They're our LP. We have one LP. We're looking to do $500 million this year in the STNL essential retail space. What I think makes us unique is the senior team consists of one half real estate, myself and our COO. We live on the real estate side. The other half of our team are data and technology professionals. So one is the former head of data analytics and scouting for a Major League Baseball team. So he's kind of a Moneyball type individual. The other is a full stack developer and data scientist based in Estonia. And we've developed tools that we use to invest in real estate in unique and special ways. Ultimately, the idea being to change the way that real estate's bought, closed, managed, and sold. So that's my day job. Now, how Julie and I met, and there's several of you are familiar faces on the call. Hello. And so those of you I know through Adventures in CRE, this is kind of a labor of love. This is a strange hobby that I have. When most people are watching the Super Bowl, I'm building models and sharing them on this website. I started it in grad school. It's called adventuresincre.com. It's an incredibly lame name that I never anticipated anyone going to. And really it was like myself and my co-contributor on the website, Michael Belasco. We have this strange passion for building models in Excel. And so anytime you build something that you enjoy, you want to share with other people. And in this day and age, what do? Well, you go to the internet and you share them. And so it really started out as this way for us to share our personal library of real estate financial models. So we started in 2014. It's grown well beyond anything we could have imagined. We now have a team that help us run it. And we've now built, first we get the most visitors, if that's even, anything to be proud of. This is such a niche space, but this month we had over 100,000 unique visitors come to the website, download our models, learn from the tools that we have. Thus far, we've put together a library of 61 models. We give all of them away for free. And we do it because this is a passion that we have for teaching people real estate financial modeling. Now, we also have a training program that teaches people to build models on their own, ultimately with an institutional focus. Now, as we've grown, we've come to train individuals at some of the top firms and universities in the world. So we train all of the real estate analysts at Goldman Sachs. We train real estate professionals coming out of the MBA school at Columbia and a whole host of other companies and universities. And it really is just something I enjoy myself and my co-contributor. And so, that's me in a nutshell. But what is real estate financial modeling? Again, it's a tough topic to describe. Everyone has a slightly different definition. Again, this is a skill that I've spent, because I'm passionate about it, 10,000 plus hours doing. And that's why I want to spend the balance of this time is talking through what real estate financial modeling is and what it looks like. And for those of you who are brand new to real estate investing, I hope that you'll learn something. And those who have done this for decades, I hope you'll learn something. I hope I'll give a slightly different spin from what you're used to. So what is real estate financial modeling? I think most of us know what accounting is, right? So if you think about accounting is a backward, it's looking back at cash flows, right? It's what happened in the past. That's accounting. Finance is forward looking. It's making an educated guess about the future of cash flows. And so ultimately, when we say real estate financial modeling, again, it's an exercise in forecasting the future. And we make the big bucks either as real estate investors or as employees working at large real estate investment firms. We make the big bucks when we're able to accurately forecast the future. We lose money when we inaccurately forecast the future. And so, again, ultimately, that's what this is about. So what I'm going to do now over the next few minutes is let's forecast the future together using a few of the just kind of very basic tools that we have in our toolbox in real estate financial modeling. I'll also look at a variety of deal types. And hopefully what we get to is a place where everyone learns a little bit about this skill. So let me open a spreadsheet. This is where we spend a lot of our time. And so, when I say, oops, sorry, let me actually just close that all together. Hang tight. There we go. Pull that away. Okay. So when we say forecast the future, if you think about real estate today is a function of what cash flows will or can produce, or the value of real estate today is a function of what cash flows a real estate can or will produce going forward, right? So if you think about it, if you're familiar with the direct cap method of valuing real estate, or in other words, cap rates, right? You've probably heard of this. You take a stabilized net operating income, let's say 900,000, and let's say that your market cap rate is 6%, or in other words, comparable properties, identical properties out there in the world that are fully stabilized, they trade at a 6% cap rate, or in other words, net operating income divided by some value equals 6. Or in other words, we can take our net operating income, we divide it by 6, and we get a value, right? So what we're saying is this asset, and it could be anything. It could be industrial, it could be multifamily, it could be a hotel, it could be whatever. Has 900,000 in annual net operating income, stabilized, meaning its highest potential is worth $15 million. Now, why does that matter? Well, what we're really saying is we believe that this 900,000 going into the future perpetually is sure. Or in other words, we forecast that this property will produce forever $900,000 a year net operating income. And at a 6 cap, therefore, it's worth $15,000. Okay, so I would imagine everyone on the call understands this concept of a cap rate, right? NOI divided by cap rate arrives at a value. What you're really doing in direct cap is you're doing a discounted cash flow method where your net operating income is flat perpetually, forever. And so if you remember, we used a 6 cap here, 6 cap rate. I can demonstrate that this 900,000 is assumed to be perpetual. How do I do that? Well, I'm going to use a discounted cash flow method. And so what did I say? Okay, we pay $15 million for this property, right? 15 million. And we're going to get every year 900,000. Oops. There it is. 900,000. And at the end of the period, we're going to sell it for 15 million. All right. Because again, 900,000 perpetually at a 6 cap. We then take the internal rate of return of that. And what do we get? A 6. So when we say a 6 cap, what we're really saying is I'm going to get 900,000 perpetually, and I expect a 6% return on that 900,000. Or in other words, and therefore I will pay 15 million for this. Or another way of looking at it is I pay 15 million, I get 900,000 for some period of time, and at the end I get my money back. And what do I get? A 6%. Now, if you spend any time in finance, this is a bond right here. And so when you're buying real estate, you're really just buying a bond, but it's a bond with variable cash flows. And what are those cash flows? Well, we don't know. And that's where we forecast the future now. So none of us actually expect our cash flow to be 900,000 per year perpetually. We use this direct cap method because it's a quick and dirty way to arrive at a value. And by the way, the history of this goes back to the 60s, at a time where they didn't have the tools that we have today. And therefore, they couldn't do an internal rate of return calculation in the way that we can today in such a quick and efficient way. It's long math. And so they would use this perpetual method to arrive at a value. Today, what we generally do is we use a discounted cash flow method to arrive at a value. And we say to okay, so we're going to say, all right, we think it'll do 900,000 in the first year, but you know what? I think it's going to grow by 3% each year thereafter. And I'm gonna cap that last NOI also by 6%. So I say that cap rates 5 years from now will be the same as they are today. And now I'm gonna earn an 8.46% return. Now, how do I value this then? I say, okay, well, I'm gonna solve for an 8% internal rate of return. Or in other words, I would expect an 8% return, internal rate of return in order for this investment to be worthwhile. So what I do is I come up here, and again, the very quick and dirty way, a way to do this is I'm just going to adjust this value until this is equal to 8%. And I can do this manually. Oops, I missed a 0. I can do this manually, or I can use a tool such as in Excel, they have something called goal seek. And I say, okay, I want this to be equal to 8% by changing what I pay for it up front. And well, you get the idea, right? So you iteratively arrive at some value. And that's the way that institutions value real estate. They forecast the future. They solve for, we call it a discount rate, but they solve for some return metric. And therefore, that's what they pay today. All right. So again, coming back to like our job as real estate investors is to forecast the future. Now, there's a lot that goes into it. Everything from your ability to manage. Having a good property manager is going to determine what kind of net operating income you're going to get that property is going to throw off every year. Having efficient cost of capital. So right here, we're looking at this without debt, but you apply debt now, you're going to have the lower your interest rate, and the higher your loan to value, the higher your return is going to be, right? So all of those things play into this number, play into that number, and ultimately determine what you should pay for it today. Okay. Now, many of you are involved in value add investing, buy, fix, sell, buy, improve management, sell, buy, improve management, recap, meaning bring in outside investors, pull your equity out, go to the next deal, right? And you look at this and you say, well, that's not really what I'm doing, Spencer. First off, this is what you're doing. It's just, this is the method by which you would value today the property. But let me show you another methodology that we look at it, just quick and dirty value add, right? So let's again say that 900,000. That's today. Okay, so we buy this property. It's throwing off 900,000 of net operating income today. Let's assume that this is stabilized, right? So it's fully occupied. It's operating as you'd expect. However, there's this opportunity where I could go in and, in the case of a retail deal, I freshen up the outside. I re-tenant my anchor tenant. That gives me a bump to my inline tenants, and now I take NOI from 900,000 to something else. Or in a situation I think most on the call are more familiar with, I buy an apartment deal. I throw in granite countertops and faux hardwood floors, and I juice my rents by $100 per unit per month, and now all of a sudden I have $1.1 million in net operating income. And my cap rate, right? My cap rate's the same. This is a market-driven value, but I've increased my value, in this case, by 3.3 million. Or in other words, as soon as I execute this strategy, I've increased the value of the property by 3.3 million, right? So that's the value add exercise. Now, what's interesting is I could also do this calculation using either, okay, the direct cap. I could do it with the DCF, and depending on who you are, you may choose one or the other. And so if you go to our website and you download any of our models, you'll find that we use this methodology. We're forecasting years of cash flow out in the future, and that helps us then derive both our in place and our forecast, understand what the returns are going to be. Because there's a lot more that goes into us. Yeah, it's $15 million today, but what do I got to spend to get this 3.3 million? Right? Am I spending 750,000? Am I spending 2 million? Am I spending 5 million? Right? And that then ultimately determines, is this worth doing? And that actually gets to the next concept. So this is a concept that's generally used in development, but also could be applied to value add. So again, we have so we go out and we build a project. Good friend Lane Bean's on the call. He just did a slam dunk, or not slam dunk, home run development in Austin. Let's imagine that we went out and we developed this for 12 million. Okay, that was our project cost. Everything from buying the land to entitling the property to plans, construction drawings with architecture and engineers, to hard costs, to soft costs, to financing costs. 12 million, we're all in on this. And it took us 24 months to get to that point. And then we spend 12 months to lease it up. And at the end of that 36-month period, we have a property that is throwing off 900,000 in net operating income, is worth a 6 cap, and is valued as 6 cap, and therefore is worth $15 million. And so in this development, we generated $3 million worth of profit. The difference between our cost and the value of that at the end of that 36-month period. Now, again, this cost could be the equivalent of our value add, right? So let's use this as the example. We pay $15 million for this apartment deal. We put $750,000 of improvements into it. So we're in this 15.75 million, but we have $1.1 million in NOI after we do that. And our profit, 2.583 million. Okay. But ultimately it comes down to, we're forecasting the future here. We're going from, in the case of a value add deal, 900,000 in net operating income. We're forecasting that it's going to be 1.1 million at some future point. We're forecasting that it's going to take us 750,000 to do this. We're forecasting that we can buy this at 15 million. We're forecasting that the cap rate is going to be 6 at whatever point we're done with the value add plan. And we're therefore forecasting an 8.3 million. We're forecasting the future. And that's why we're paid the big bucks. If we're wrong, we lose money, right? And so as you think about, so I'm going to get to return metrics in a minute, because that's somewhat of a different topic. What I've really looked at here is valuation and forecast. Ultimately, as you look at your career and as you think about how you underwrite, how you do real estate financial modeling, think in terms of how you can accurately forecast the future. And now, what are some tools to help with that? Well, there's all these data providers, right? They're going to give you their forecast, and that plays a part into it. The more deal knowledge you have is going to help, right? The past isn't necessarily indicative of the future, but it sure helps us forecast the future. And so, to the extent you have past experience, you're more likely going to be able to forecast an accurate future. The better your network is, I can't tell you how valuable network is to this very process, because you meet Lane Bean, and I tell you, Lane Bean probably knows more about new build, ground up development in multifamily in Austin than many people on the call. And you decide you're going to do a ground up development in DFW. You call up Lane, and he's going to be able to tell you all sorts of things about costs, all sorts of things about lease up pace, how long it takes you to actually lease up a building, property management and the nuances of that. And so having a network of individuals that you can lean on who will help you derive. So these little blue cells you see, we call them assumptions in our models. Every single one of these assumptions drive, or that's the forecasting of the future. And having people in your network that can help you derive realistic assumptions is invaluable. That's what ultimately determine whether you're able to do this accurately. Now, let me stop there. I'm going to get to returns in a minute, because I think that's important. Let me ask, are there any questions at this point? A lot of us on the call, that was a lot of basic material, but a lot in a short amount of time. Any questions that I can answer before I move on to returns?
I have one question.
Yes, Dorian.
Can you, what is the relation between the IRR and the cap rate?
Yeah. So the cap rate is your IRR without growth. Okay. So if there's no growth in either your value or no growth or change, and growth can, I should say, there's no change. There's no change in your cap rate. There's no change in your net operating income either up or down. It is the same. And again, we prove that out by simply going 900,000, no growth, 6 IRR, 6 cap rate, right? So anytime you see a 5.5 cap rate, all that's saying is, if that NOI stays the same forever and the value of the property stays the same forever, the cap rate equals the IRR. Great question.
I have a question, Spencer.
Yep.
What would you say is a better way or a simpler way to predict exit cap rate in a certain market? Let's say you have CoStar, maybe a couple of other tools. Which way would you recommend? Which tools would you recommend to predict exit cap rates?
Yeah. So when I do cap rate analysis, so that's a great question. Like here I wrote market cap rate 6. How did I get this 6? That's a blue font cell, meaning that's an input that I had with certainty I wrote down. What I do is I look and I find a property that has similar or exact characteristics to the property that I'm underwriting. So let's say that this is a 200 unit garden style deal built in 1999. I'm going to go out and find similar vintage, similar location, similar build quality. It will hopefully be in the exact same condition, right? It hasn't gone through a renovation plan yet or not. And I'm going to find those comps, and each one will have traded. And I'm going to look at occupancy levels, and I want to find properties that are very similar. And I'll then look at the cap rates that those each traded at. I might make adjustments. This one has slightly lower occupancy, or this one had some renovations done, and I might make some adjustments, and that will help me arrive at the cap rate. Now, what sources do I use to find those comps? CoStar is one, Axiometrics is another. The best, to be honest, is your own personal experience or context you have. So every one of you is out there underwriting deals, most likely, and if you're not, you will soon. Every time you underwrite a deal, you need to add that to your database, because that becomes a comp for a future deal. And so you looked at a 1998 built garden style deal three weeks ago, you know exactly what the rents are, you know the condition of the property, you know and hopefully at that time, you know the cap rate that it traded at. That becomes now a comp that you can use in your analysis. So yeah, it's a combination of data to providers like CoStar and your own personal knowledge. Oh, and brokers are a great resource for this as well. So lean on them as well. Great question, Tim.
So Spencer, you
Yes.
You just discussed market cap rate, but how does that relate to your analysis in reversion cap rate and the historical averages as it relates to reversion cap rate?
Yeah. So when we say reversion cap rate, yeah, and great question, Jim. So what we're saying by reversion cap rate is this value in we call it time zero. That's today, right? When we buy this in time zero, we're paying a 6 cap rate, or in other words, our net operating income divided by our value, we're paying a 6 cap rate. So what Jim's asking is, what cap rate do I use for my reversion? That is the value of the property at the end of my analysis. And the simplest way is to use your going in cap rate or the market cap rate today. The problem with doing that is, what do we have 5 years from now? We've got a building that's 5 years older, and we have 5 years of uncertainty. Now, if you've ever looked at a interest rate curve, the best would be a rate curve. So look at, say, the treasury rates. What is the yield on a 1-year treasury? It's less than 1%, right? What's the yield on a 30-year treasury? 2 something right now. The 10-year is 160 something. So why are the rates higher out in the future? Because of uncertainty. And so when an institution calculates its reversion cap rate in the future, it always grows the cap rate. And so, and the convention in an institutional world is 5 basis points for every 1 year of analysis. So in this case, I would use a 625 cap rate. Now, I didn't in this case because I was using a very simple example to show how cap rate and IRR are the same when there's no growth in your value or your NOI. But in the sense of like arriving at a reversion cap rate, my recommendation is 5 basis points, or you can't go wrong with 5 basis points a year going forward. Great question. Any other questions?
So I've got a question about how the institutional buyers and or REITs, how do they automate the process of inputting the information from the OM, the T12, and the rent rolls to speed up underwriting? And how does that play into your model?
Yeah, there's a few tools out there. Red IQ, if you're familiar with them, help with that. Most of it isn't automated though, Jim, to be frank. They have analysts that come out of great universities that they take OMs and they input assumptions, and then they have an associate and a director on the team that have some market knowledge that help fine tune the assumptions. But it's in the institutional world, it's not, unfortunately, it's not very automated right now.
Bastian had a question for you. If the property is sold in year 5, do you use year 5 NOI or year 6 NOI to determine sales price in year 5, and why? Yeah, good question. So that's the question. Do you use forward-looking NOI or backward T12 NOI? It depends on who you are in the transaction. But generally speaking, you're going to use the forward-looking NOI. If you're a lender, you're probably using a T12, and we all grumble. So it really depends on your risk, your aversion to risk in the deal, or your incentive in the deal. Sellers, of course, always going to want the forward-looking NOI because it's going to be higher, most likely, than the T12. The buyer might push for a T12, even though the buyer's doing some pro forma. But again, it ultimately depends on the party that you're talking to. Best practices, you assume a forward-looking NOI, but don't be surprised if your lender pushes back on that. Sorry, Julie. I'm with you, but I have to be conservative, so that's true.
Yeah.
I have a
Let's-
question.
Yes.
Rick
How-
always has a question, so he's holding his part in this deal. So go ahead, Rick.
Good.
Thank you. How do we factor in appreciation for example, in a market like Phoenix, where we know there is appreciation? Is it just compressing the cap rate, or how do we we just talked about in adding 5 basis points for every year?
Yeah. Yeah. So cap rate and growth are two different things. Cap rate is a function of alternative investment options, right? So cap rates compress when rates compress. Cap rates expand when rates expand. Now, this isn't always the case because when there is greater comfort with risk in the market, you'll have a compression of the spread between rate. And when I say rate, what I'm really talking about, so in finance, we call it the risk-free rate. It's essentially so let me step back here. And I hope I'm not confusing too much, but every investment is it's a comparison to all of your alternatives. So if you can invest $100 today, your options are you put it in a savings account and earn 10 basis points. You buy government treasuries, and government treasuries are considered risk-free. So you could buy government treasuries. So you buy a 10-year bond and you earn 1.6%. Those are your alternatives. And then you could buy corporate bonds, and corporate bonds, depending on the riskiness of the corporation, might yield anywhere from 2% to 10, 12%. So you could buy government bonds, or you could buy real estate, right? And you're never going to pay for real estate a cap rate, or you'll never expect a yield lower than the risk-free rate, right? Why would you be comfortable with a 1% return on a real estate deal that is illiquid and is risky by nature when you could go buy a government bond and earn 1.6% on a 10-year bond, right? So every investment is this exercise in comparing that to all of the alternatives that exist out there. And so cap rate is simply a function of that investment compared to all the alternatives that are out there. So the cap rate is unrelated to the property that you're buying. And I know for many of that doesn't make a lot of sense because you've thought of cap rate as a return metric. Cap rate's not a return metric. It's a valuation metric. And the cap rates are driven by the interest rate or the rates of the alternative investment options that exist out there. What's in your control is the net operating income, the income that asset produces. And so now in terms of like what you assume for growth, say Phoenix, an institution would say, okay, you can expect growth to be equal to inflation, right? Rent's not going to grow any faster than inflation. If you are going to make an argument that rent will grow faster than inflation, tell me why. And your argument will be demand will outstrip supply. And if demand outstrips supply, growth in rents will outstrip inflation. And we've seen that in a lot of places. That's why real estate's somewhat cyclical, because you go through these demand and supply phases where there's more demand or there's more supply, and that has a direct impact on rents. Rent ultimately determines, or rent growth generally is the major driver in your growth in net operating income. Now, obviously operating expenses also play into that. But a long-winded answer, Rick, I apologize. And it maybe confused people more than it helped. But when you think about your property, what you have control over is your growth in income.
So there is no way to figure these, like the market appreciation overall bake that into your underwriting.
So your market appreciation will be baked into your market rent growth assumption, right? So you're going to assume some growth in your market rent. You'll assume some growth in your operating expenses. That will get you some growth in your net operating income. And assuming cap rates hold, you will have appreciation in your asset.
Okay. Thank you.
Yeah.
So Spencer, on your return metrics for your institutional investors, your LPs, what are they looking for as it relates to cash on cash, IRR, equity multiples or IRR, and which of those metrics are most important to them?
Yeah, really good question. So let me talk through kind of my return metrics worksheet, and I think that'll answer most of your questions, Jim. And then I can get into specifics. Every property type, every investment strategy, the target returns will vary. But so here we have this cash flow stream. And again, I'm holding it flat. Notice no change in net operating income over 5 years, no change in value. Therefore, we know that this yields, and I go equals IRR, a 6% internal rate of return. If you're an institutional investor, internal rate of return is one of the most important metrics. Why? Because institutions invest in a whole basket of assets, and they want to compare their real estate return to the return on all their other assets. And they will benchmark this return to some benchmark, and that benchmark is calculated with an IRR. So that's why you see IRR a lot. That's because it's the metric that institutions use to compare this asset to all of their other assets that are non-real estate. Another metric they use is called equity multiple. I've seen people call it a multiple on invested capital. It really is a metric that determines the growth in your capital as an investor. It's calculated, okay, we use a sum if. This is greater than 0 divided by sum if this is less than 0, right? Oops, what did I do? Oh, I know I did. Divided by, okay. I forgot to put a negative. So this is our equity multiple. So what we're saying here is our invested capital grew by 1.3 times. So we put in 15 million and we got out 1.3 times 15 million. This is a really important metric, right? It tells us how much our capital grew over the whole period. So we held it flat. Let's say that net operating income grew by 3% per year. Let's cap the forward-looking 12 months. And let's use a 6.25 cap rate for our reversion cap rate. Okay. So we bought it for 15 million today. We just held it for 5 years. We didn't do anything to the property other than we just sat on it for 5 years, and we enjoyed the growth in rent that the market gave to us of 3% or 3% in NOI. We then sold it in year 5 at a 6.25 cap, which means we sold it for just shy 6.7 million. Our internal rate of return before taking into account debt, so this is without debt, 8.26%. Our equity, our capital grew by 1.43 times. That's equity multiple. Both of these are considered investment metrics. Okay, these are metrics that help us determine, is this an investment that is worth doing compared to all of the alternatives that exist to me out there? Cash on cash return is an operating cash flow metric, meaning it tells us how much current cash flow does this property produce. So we calculate it by taking, in this case, net operating income. We divide it by the amount of capital that has been contributed to date. It's calculated on an annual basis, and looky there, it's a 6 cash on cash return in year 1. And then because our net operating income is growing every year, our cash on cash return grows every year. And then often you'll do an average over the hold period so that we have an average cash on cash of 637. Now, this is a operating cash flow metric. This doesn't tell us if we should buy this investment or not. And let me demonstrate this. So let's say that this had an NOI of $1.2 million every year. It's an 8 cash on cash return. However, let's say that for some reason this asset actually loses value over time. And I can give you an example of when that happens. But let's say that this asset is only worth $5 million at the end of a 5-year hold period. If you bought simply on cash return, you'd say, wow, this is a great investment, right? I'm earning 8% every year. You actually lost money. And so while it provided some nice current cash flow, the nature of the asset itself was depreciating in value over time. And an example of that would be a single tenant net lease essential, or a single tenant property. Retail as an example. So let's say that you went and bought let's pretend that this was a Walgreens, and Walgreens was struggling at this location, but their investment grade tenant, they signed an agreement to pay rent through some period of time. At the end though, they bail. And what you have is an empty Walgreens building that really isn't worth a lot because there's no other tenants that necessarily are going to backfill that. And so you sell the building, you scrape the building, you just sell the land. And Walgreens may not be the perfect example because there are substitute tenants for a Walgreens building. Dollar Tree is an example. But imagine you have a building that becomes obsolete such that at the end of your hold, the building's really not worth anything. You got to scrape the building, the value's in the land, you lost money on this deal. And so cash on cash return is a great metric to understand how much cash flow the property throws off in a given period. It's not an investment metric that tells you whether you should buy a property or not necessarily, right? So another metric would be net profit. This is a pretty simple one. We just simply take the sum of all of our cash flows, negative and positive. So this here produced a net profit of 6.471 million. So those are some basic metrics. There's other metrics though that are important to value add and development. So the two big metrics I look at are yield on cost as it relates to market cap rate and the spread between those two. So when I say yield on cost, let's take, this is our value add scenario. Okay, so we bought it with 900,000 in NOI. We did some sort of improvement plan that grew NOI to 1.1 million. We, again, bought at a 6 cap, sold at a 6 cap. We saw 3.3 million in value creation. The question is this a deal worth doing or not? Right? And we use what's called investment spread. In the case of development, it's called development spread to determine whether it was a deal worth doing. So we take the new NOI that we get for going through the value add plan and we divide it by the cost to get that NOI. That's our yield on cost. We then compare that yield on cost to the market cap rate, in this case, 6%. This is typically measured in basis points, which 100 basis points is 1%. We would yield 133 basis points of investment spread. So the spread between our yield on cost and the market cap rate is 133 basis points. And then the firms will have a target spreads that they want in order to do a deal. So let's use another example. Let's say that this was actually a 7 cap. Well, what did I do wrong? Oh, yeah, let's do 6. There we go. So now we only have 33 basis points of investment spread. This isn't worth the risk, right? You might as well just go buy a stabilized property rather than taking the value add risk. So that's yield on cost and investment spread. I think the purpose of this exercise wasn't necessarily to teach you all of the metrics. The point was there's different metrics for different scenarios. And so the first point of this is use the right tool, the right metric for the job. When I was in high school, I was an apprentice plumber. It was like my high school job. I did it for 4 years. On day one, my boss came to me and said, Spencer, the number one rule of this job is use the right tool for the job. That's the case for real estate financial modeling. There's a lot of metrics out there. Make sure you're using the right metric for the job. The second is it's all about consistency in your methodology. So what you'll find, I've worked at enough firms now, every firm has slightly different methodologies and none of them are necessarily wrong, so long as there's consistency, meaning You underwrite 1,000 deals, you use the exact same methodology to underwrite those 1,000 deals, such that you can truly compare. And real estate finance is ultimately an exercise in comparison. You can truly compare one deal to the next. And so if you have a metric and you call it, the ABC return metric, and you use it on every single deal, that's great. So long as you use it the same every single time. And therefore, when you look at 100 deals, you know that deal number 101, how it compares to the last 100 deals. And so that's return metrics. Now, back to Jim's question. And I know, Julie, I'm sensitive to time, so you cut me off when I'm done. But what do institutions look at? It's going to depend on a value add apartment strategy. They're going to expect mid-teens levered IRRs. On a core apartment deal, they're going to expect high single-digit, low teen levered IRRs. They're generally analyzing on a 10-year hold. Doesn't mean they'll hold for 10 years. They may hold indefinitely, they may hold shorter, but they're going to look at everything on a 10-year hold. Again, it's all about consistent methodology. Yeah, that's the final answer to that question, Jim. Yeah. Any other questions for me? So that's the end of my content. I'd love to answer any other questions. Happy to talk about this. This is a topic that I'm truly passionate about. So.
Yes, it's very clear. And man, oh man, I think I need a nap after that. That is intense. I love it. I think that, Kenneth, you had a question. Does this, or how do you, I lost my question. How does this, or how do you account for loan amortization for the 5 years?
How do I account for the long amortization and what in the loan?
The loan amortization. Yeah, you had said that it was not with the loan in the returns.
Yeah. So you will then layer in debt. And so you arrive at net operating income. You then subtract out capital expenditures, by the way, which I didn't do for simplicity's sake. You arrive at what we call cash flow from operations. You then subtract your debt service. Debt service is a combination of your interest and principal. Your principal is the amortization part, right? Interest is what you're paying the lender. And you'll arrive at a cash flow after financing line. That then becomes your levered cash flow. And you run the exact same return metrics on levered as you do on unlevered. Assuming your interest rate is lower than your unlevered IRR, you will get a positive leverage. Or in other words, the return will be greater on a levered basis than it is on an unlevered basis. Yeah, great question.
Let's see. There's another question here from Clay. If the risk-free rate goes to 5%, do all 10-year models underwriting at just a 5 BIP increase or year blow up?
Yeah. Well, first off, if it goes to 5, we're all going to be in trouble. And that would not take it. In fact, right now we're still using a 5 per year. If you believe that inflation is coming, if you believe that the 10-year treasury will climb at a rate greater than 50 basis points, and by the way, the correlation between the 10-year and the cap rate is not 1-to-1, and so there's some other factors that drive it. But ultimately, if you look at a chart of cap rates and you compare it to the risk-free rate, you compare it to government treasuries, they track one another, and they'll sometimes condense and they'll sometimes widen, depending on the we call it risk on versus risk off, the risk tone of the market, right? So what you notice, like at the start of COVID, treasury rates dropped, and yet bonds widened out, and real estate cap rates held pretty steady because cap rates tend to lag the more liquid markets. But you have a gap, a widening of the spread between your bonds and your risk-free rate. But when you get in times where people are feeling good, we call that risk off. that spread narrows. And so it's not like a perfect correlation, but they ultimately do come back and they track one another. And so if you're thinking about a 10-year hold and you believe that there's going to be inflation and an increase in rates over that time, you might use 100 basis points in growth in your cap rate, maybe more. If you use too much more, and it's hard to justify any deal though. So
Would you get a positive cash on cash return, but a negative IRR return in that case?
yes, yeah, good point. Yes, you could. You could. If your cap rate, if the 10-year went to 5%, that would probably push cap rates into the 7.5s for multifamily. Yeah, you'd be better just to hold that asset long term. Now, keep in mind though, when you have inflation, you also have, so when rates rise like that, you're likely going to have inflation in rents. And so now you might see 4% rent growth. And if you have 4% rent growth, then your NOI is growing, and therefore your value may be holding. And you'd have to do that analysis to determine. So your cap rates are growing, are increasing, but your NOI is growing at a faster rate than it otherwise would, and that might compensate for the rise in cap rates.
Well, I want to thank you for being here, Spencer. I feel a lot smarter, and I know that many of our listeners here are just so grateful that you shared so much knowledge with us.